Hello everyone, welcome to the quarterly investor call for UTI India Dynamic Equity Fund. The agenda for today's call will be introduction and welcome by Ms. Shweta Rungta, Business and Investment Analyst at UTI International. Country macro update on India by Mr. Vetri Subramaniam, Chief Investment Officer of UTI AMC. UTI India Dynamic Equity Fund update by Mr. Ajay Tyagi, Head of Equities at UTI AMC. We will now begin the session. Kindly note, we will also have a Q&A session at the end. Please feel free to post your questions on the chat box anytime during the call. I would now invite Ms. Shweta for the welcome address.
Thank you, Shivani. Good evening, ladies and gentlemen. Thank you for joining us today. Currently, India is under the spotlight as it is in the middle of its general elections. While foreign investors have understandably demonstrated caution by offloading equities in recent months, the domestic trends within India tell a contrasting and more positive story. Although the market is hovering near all-time highs, DIIs are aggressively buying and soon expected to overtake foreign institutional investors in ownership of Indian equities. Remittances from non-resident Indians have reached record highs and crossed the $100 billion mark. The number of new demat accounts opened are also at record highs and surpassed 150 million. Additionally, the Indian rupee has been the most stable emerging market currency in the last year. So much so that foreign investors are now showing interest in investing in long underappreciated Indian fixed income. What's remarkable is that these developments are unfolding during election time, a period typically dominated by caution and increased market volatility. India appears to have decoupled from the conventional economic responses typical of such periods. It's almost as if the nation is dancing to its own tune, undisturbed by the global economic disruptions that often impact other markets. The current policy reforms have shielded the economy from immediate shocks and laid the groundwork for long-term growth. As investors, this should be a signal to consider the long-term potential of the Indian market. The resilience of the economy, coupled with strong domestic support, presents a unique opportunity. Investors should look beyond short-term volatilities and align the investment strategies with the sector showing sustainable growth. Before I end, I would like to quote Mahatma Gandhi, "In a gentle way, you can shake the world." Today, India reflects this sentiment, quietly but powerfully asserting its potential on the global stage. Thank you.
Thank you, Shweta. I would now request Vetri to start with the country macro update.
Good afternoon, good morning, good evening, wherever you're joining us on this call today. Thank you, Shivani. Thank you, Shweta. And as they said, I'll kick off with giving you an update on the macro trends in India. And I'm sure there will be some questions about the elections, which are currently ongoing across India. The next election date is the 20th of May, which is next Monday, when, of course, even the city of Mumbai. So I'll be casting my vote as well on the 20th of May. But let's get on with, sort of discussing the economy first. And this might actually speak to some of the questions that I've seen which have already come in, but let me, talk us through these few slides. So I think one of the things which is sort of underappreciated in the Indian context is how the government over the last few years has managed the fiscal deficit in a very disciplined manner and with a quite a bit of deftness. As a result of which, if you look at the left-hand side where you can see both the fiscal deficit of the union, which is the central government, which runs the entire country, and then on top of that, you also have the fiscal deficit of the states. Now, in 2020, when revenues to the state collapsed, the combined fiscal deficit surged to about 12%, but immediately the year thereafter, they started to consolidate it. The consolidated fiscal deficit has now dropped dropped back to little over 8%. And in fact, the fiscal deficit for the union government has dropped to below 6%. And as many of you would already be aware, the target is 5.1% for the fiscal year March 2025, dropping down further to 4.5% in 2026. So yes, there was a big surge in the deficit in the pandemic year, but since then the attempt has been to bring it back to where we were in the pre-pandemic period. You can also see the impact of this on the right side, which actually talks about the absolute deficit. And what you can see here when you talk about the absolute deficit is that after spiking in 2020, the absolute deficit is more or less staying unchanged over a period of 4 years and forecast to stay the same over the next 2 years as well. So the way we are actually achieving the reduction in the percentage fiscal deficit is by allowing the magic of growth to solve the problem at the denominator, while holding the numerator, which is the absolute fiscal deficit, almost unchanged over a 5 to 6 year period. So this is one of the stories of, I think, good governance and good financial management by the government. What's underpinning this? Two trends. There is a structural improvement in the tax to GDP ratio, simply because the collection of taxes has improved. On the left-hand side, you can see personal income tax, and you can see how there's been a surge in personal income tax over the last few years compared to the trend line. And on the right hand side, those of you who are familiar would know that India has implemented the goods and services tax, integrating taxes on the production of goods and services across states and the union way back in 2017. And as a percentage of GDP, we have seen this GST tax continuously increase from the pre-pandemic base. So these two put together have really sort of driven the structural improvement in tax to GDP. The number that's not on this slide is corporate tax to GDP. That is still running slightly slow. And the reason it's running slightly slow is that there was a big tax cut which happened in India in 2019. And therefore, as a result of that, corporate tax collections have been moving up only slowly since then. But they are growing. And, if we see the economy maintain momentum, then I have no doubt that at some point that should. Moving on to the next slide. What is also remarkable is the government's role during the post-pandemic period in terms of trying to step up the total capital expenditure which is done by the government. What you see over here in this chart, the blue bars reflect capex done directly by government, as well as what we call off-budget capex, which is done by companies owned by the government. What you can see over there is that from 2020, there was a very strong surge that happened in capital expenditure by the government. So even within the context of fiscal consolidation, they actually emphasized capital expenditure over revenue expenditure. And therefore, as a result, you're seeing the strong improvement in capital expenditures, even as revenue expenditures were controlled. But as we get to 24 and 25, you are seeing some slowdown on a year-on-year basis in capital expenditures, partly because of the need now to achieve those fiscal targets. But the heavy lifting, if you look at the period from 19 all the way to the forecast in 2025, which is a 6-year period, total capital expenditure by the government is more or less sort of doubling during this period. And I think that's, the heavy lifting that the government has done for the economy during this period. Having said that, what is the private sector doing? What you've got here is a very long-term chart. The bars represent corporate profits, which is the BSE 500 companies in the economy. What kind of profit growth do they have? The scale is on the right side. So you can see almost 2 decades ago, there was a period where corporate profits were growing at anywhere between 20 to 30% a year. And now again, in the last 4 years, we're once again seeing an environment in which corporate profits are growing about 20% a year. But there is one very big difference between these two periods, which is reflected in that blue or greenish line that you see, which is to say that 2 decades ago, Indian companies were making record profits, but in fact, their free cash flow was negative, which means all their profits were getting recycled into capital expenditure, and they were even raising equity and borrowing money to drive capital expenditure. Whereas what we see at this point of time in the last 4 years is that profitability has moved up, but free cash flow has also moved up. So companies are not investing at a very dramatic pace. In fact, they haven't even sort of used their entire free cash flow to invest aggressively. And therefore, I think the economy is at a stage where the baton needs to pass from the government to the corporate sector in terms of who will really continue to spend aggressively in capital expenditure. Moving on to the next slide. Are corporate balance sheets in a good place to drive capital expenditure? You can see on this slide a very long-term debt to equity trajectory for large listed companies. Look at the starting point somewhere in about 2004, 2005, when the previous capital expenditure boom started, and you'll find that today's debt to equity is very similar to where we were 20 years ago, which is the point in time where the corporate sector not only invested its profits into capex, reinvested its profits into capital expenditure, but they also were willing to borrow to increase their investments. That is a trend that we are yet to see in terms of companies pick up their capital investment, but there is no doubt that balance sheets are very favorable. The initial conditions for a pickup in capex as far as the financial condition of large listed corporates is concerned is quite favorable. Moving on, this is just again a longer term sort of trajectory of total debt to GDP. The reason I put this slide out here is just to make the point that, unlike some of the other economies where debt to GDP has become a very significant concern, of course, China at the forefront, Japan, we know, has had an issue on debt to GDP, and of late concerns are also mounting about the fact that US debt to GDP is going up because, fiscal deficits over there appear to continue rising. But in India's case, total debt to GDP, there was a bump up in the pandemic year, but since then, again, because of strong growth, we've managed to deflate it back, and I think over the next few years, it should maybe hold steady at the 150, 160 mark. So not very different from where the pre-pandemic trajectory was. The only significant difference over the last 5 or 6 years is that because of corporate profitability, financial corporations, non-financial corporations' share of total debt in the system has actually come down, whereas households have actually added to debt. But when we look at total household balance sheets, we don't think at this point of time it gives us significant concern. But I must say the central bank has already made some policy interventions because they were concerned about the rise of unsecured retail credit, and they have taken several policy measures to try and slow that down to some degree. Moving on, this is just a slide of where we are in terms of trajectory. I won't spend time on this, just to point out that real GDP growth in the year ended March 2024 estimated at 7.6%, expected to slow down to about 6.5%, 6.7% if you look at the consensus numbers on Bloomberg for FY25, though actually the government forecast and the central bank forecast for FY25 is actually higher than 7%. But most professional forecasters holding to about a 6.5 number at this point of time. Moving through to the next slide. The next 2 slides essentially talk about valuation. What we've got on the left-hand side is the price to book ratio of the Nifty 50, which is the 50 most large liquid companies in the country. The yellow line reflects their long-term average. The red line reflects 1 standard deviation above, which is what we would call expensive territory. And clearly the benchmark index now trading in rich territory as far as price to book is concerned. The next slide will look at the mid-cap segment of the market and the small cap segment of the market. And what's remarkable about this, because in my career going back 30 years, I have seen mid caps sometimes trading up to a premium to large caps, but the extent of premium that we see today is very, very significant. The mid cap index reaching almost 2 standard deviations to the long-term average in terms of its price to book. Same actually for the small cap index, and the small cap index actually managing to trade now at a premium to the large cap, which I have never seen in my career so far. Reflects the character of domestic flows into equity, which seems to have a very strong bias towards the small cap. So that's what's caused what I would call a bit of a dichotomy in the way I would like valuations to be. Right now, unusual to see the small caps actually trading at a premium and the nifty mid caps actually trading at a record premium, though they have traded at a premium in the past. Moving on, the next slide is really more of a snippet, but I thought this was interesting to sort of show here today. And I'll really focus on the one on the right side. One of the trends in India has actually been obviously very strong market performance. You combine this with a very active pipeline of IPOs. And as a result of this, today, 5% of all global stocks with a market cap above 1 billion are to be found in India. So when you look at the sheer range and number of companies which are now available for investment in India, which have a market cap of more than 1 billion, these account for more than 5% of all global companies with a market cap of 1 billion. And that just points to how large and significant the Indian market is becoming. As a result of, particularly the sort of pickup in momentum towards small cap and mid cap companies and IPOs, what we are also seeing is that if you look at the proportion of the top 50 companies as a percentage of the top 500 companies, going back to 2007, the top 50 accounted for 71% of the top 500 companies. That number has now dropped to a low of just about 56%, which is quite unusual, reflects in part some of the interest in small and mid caps. I would worry that what this speaks to is a broadening of the market and a largening of the market in terms of the stocks that particularly large global investors could then consider as part of their investment universe. So moving on to my final slide, I'll conclude here, on the next slide. This is just to give you sorry, can we move to the next slide? Yeah. Well, you're already familiar with the Fed, so I'm not going to talk about that. But I think in India, the latest CPI came in at about 4.85%. Growth, second advance estimate, FY24 is 7.5%. You could argue that the Indian Central Bank is really under no pressure at this point of time to cut rates because growth is robust. Inflation is within the comfort zone, but above what the central bank governor is increasingly saying should be the focus of monetary policy, which is a 4% print on the CPI. So I would say central bank likely to remain in pause mode. Plus, in any case, they'd like to sort of not be caught on the wrong foot by anything that happens in US monetary policy. So they're happy to sort of remain, on the sidelines. The profit after tax growth for the Nifty 50 companies, this data is about a week old, but with 28 companies out of the 50 companies reporting at that point of time, profit growth was about 14% year on year. And for the next 2 years, which is March 25 and March 26, consensus Bloomberg earnings growth is for about 13% and 15%. There is a dichotomy in valuations, our sort of comfort is more towards the large caps on a relative basis as compared to mid and small caps, if I were to just talk from a market cap perspective. But without doubt, the reality that we are dealing with today is a market which has become a lot more broad-based and a lot more stock-picking opportunities being available. But I'll pause at this point. That's sort of the broad macro backdrop I wanted to share, and I'll hand over to Ajay, who will talk about the IDEF strategy itself. Over to you, Ajay.
Yeah, thanks, Vetri, and welcome everyone to this quarterly call. I'll start by my usual slide, which is reiterating our philosophy. We are driven by our extremely strong focus on quality, which is very objectively defined as businesses with high return on capital employed, strong cash flows. But we don't stop at quality. We always look at businesses which, while displaying these quality characteristics, also have a strong focus on growth itself. So what defines our portfolio construction are basically companies which are operating at the intersection of quality and growth. We are not mindless about valuations, but what we keep front and center are not just valuation linked to earnings, but valuations linked to what we feel is the most important parameter, which is cash flow generation and the sustainability and longevity of this cash flow generation. Moving on, our performance, of course, as many of you would have already observed, has been weak over the last couple of years. As you can see, both in terms of our calendar year performance as also in terms of our rolling returns. And the big reason for this, of course, has been the style rotation in India away from quality and very, very convincingly into the value camp. We have a few slides which also show us where we are in that style rotation cycle. Do we expect this to continue, or do we expect this to revert at some stage? But the fact remains that apart from the style hurting us over the last couple of years, we also have been analyzing our performance in terms of whether there have been some errors of omission, really. And we do realize that there have been a few businesses which we could have caught at the right time, which did qualify as quality growth, but possibly we were slightly late in terms of identifying and putting them into our portfolio. So yes, the last couple of years have brought in a lot of learnings. The number one learning, obviously, is that we need to dig deeper. We need to be more agile. But I must also reiterate that we're not going to stray away from our North Star. We would continue focusing on companies which, to our mind, are the best candidates for long-term wealth creation, which is basically companies that are generating economic value, which again pushes us back into the quality growth camp inevitably. Yeah. The next slide talks about some of our key detractors. We've broken them into four buckets, really. The first camp is really where there has been a big upswing, a cyclical upswing in earnings. And this camp includes companies like Tata Motors, which is really, I would say, the big swing in earnings here has been on account of JLR, Jaguar Land Rover, that is. The second company is M&M, which is a diversified conglomerate. It has interests in multiple areas, of course, auto being the core, but around that core, there are multiple other businesses, which is non-banking financial services, IT services, hospitality, and so on. And the third one in this list is basically Larsen & Toubro, the big engineering and industrial conglomerate. They too have interests outside of engineering. But the fact is that in all of these companies, through the cycle, as you can see, return on equity has been low. Despite a massive upswing in earnings, ROEs continue to be low. I mean, that's one thing which can't change whether you are witnessing a cyclical upswing or any tailwinds, because essentially the ROE attributes of any business are much more sticky and they don't change just because the cycle is in favor. And in any case, what we look at are through the cycle profitability attributes. And there, all of these companies, as you can see on this table, fare very poorly. The second camp is basic power utilities in India have also done well. There has been power deficit in India, especially peak power deficit, which has led to a lot of excitement around these utilities. Many of them are putting up fresh capacities, and because demand is outstripping supply, there is renewed interest in them. But the same old story, these are businesses which are regulated. Return on capital is, of course, higher than cost of capital, but just about, and these are not high growth companies in any case. Defense has been another camp which has hurt us ever since the war broke out in Ukraine. Defense stocks globally and in India have done well. We have our own reasons of not being very positive on these defense companies. Of course, there are ESG considerations as well, but even beyond ESG considerations, we feel that these are not companies which can give us very sticky, strong structural growth over years to come. There has been certain underperformance around some of our names where we have been bullish. L&T Infotech is a case in point, has been a large holding for us, has been a top 5 holding for us for the last couple of years. Surely the company has disappointed in terms of execution. Some part of the derating is on account of what IT services as an industry is going through over the last 1 year, but some bit is also related to company specific issues around execution. This is one of those companies where we have acted and have slightly reduced exposure. Some of the banks in our portfolio, HDFC and Kotak, have also seen a massive derating. And I would say that, for a bank like Kotak, there logically is no reason because their outcomes in terms of ROAs, in terms of advances growth, in terms of NII and profit growth have been tracking what their historical trend has been. In case of HDFC Bank, of course, there has been some amount of turbulence on account of the merger that they had with their parent HDFC. While the gratifying thing is that in terms of the asset quality and in terms of absorbing or rather merging the two entities together and keeping the team intact has been a positive outcome. The negative or the surprising outcome has been around the cost of funds. We see this as a temporary factor, not a structural factor. It may take a few quarters for HDFC Bank to solve this problem. But we like these institutions, both HDFC and Kotak, predominantly for their high focus on asset quality, very strong focus on keeping slippages low and ROAs high. Lastly, there has been a steady performance. In fact, steady is the wrong word. There has been a super strong performance by PSUs across the board. Anything which has a PSU suffix around it, by which I mean public sector enterprises, you may also call them state-owned enterprises. Any company which is a state-owned enterprise in India has been, soaring very, very high. It seems as if all of them have got, suddenly discovered wings, and all of them have moved to valuations which we haven't seen for a very, very long period of time. In some cases, highest ever, and in most cases, higher than their last 10-year history. We've avoided this camp entirely, again, because of considerations of the quality attribute not getting checked across majority of them, if not all of them. We just feel that, they may be going through a very strong phase today, much of it led by this narrative, but inherently these businesses are not great in terms of execution, not great in terms of capital allocation. If you move on to the next slide, we have some of the contributors which have helped us in terms of our performance. Again, breaking it up into 3 camps. The first one being consumer services. This is that one sector where we have been bullish. I mean, this sector has been the bedrock of our portfolio for long. We were able to actually see strong performance coming in from a company like Trent. This was one company when I made a remark that possibly we were slightly late in identifying. We started building exposure in 2022. I think that we were late by at least about a year. It's done exceedingly well. And we also have a slide on Trent later on in the presentation. Zomato, which is India's largest, I would say, food tech company, has done very well. We have been invested in the company since IPO in 2021. It didn't do well, in 2022 and the early part of 2023. But execution in its core business of food delivery has been excellent. It has also forayed into quick commerce, which has given it a new, I would say, a growth engine, and that has actually been also firing for them, both in terms of increasing the overall growth, improving the overall growth profile for the company, as also as also actually elongating the growth runway. We've been underweight on certain low growth companies, which are heavyweights in the benchmark. That's helped us. Nothing unusual here. We have been negative on many of these names for many, many years now. And while these companies are indeed high quality, but like I said initially, we always look at companies which are both high quality and high growth. And therefore, in the last couple of years, not owning these names has helped us. What's also helped us has been a very careful selection of high quality mid and small caps. That's been a source of alpha for us for very, very long now, ever since we've been running this strategy, almost for 15 years now. The last couple of years were no different. Of course, the strong rally in mid and small cap did help us at the margin, because many of these names also did partake in this mid and small cap rally. Yeah. Moving on. I thought it's important for us to also tell you how are we seeing the style rotation in India, whether we are looking at this trend now actually reaching to the extreme and seeing a bit of a reversion in the coming months and quarters. While this is always very, very difficult to call out, but I thought we should at least show you some data around the style rotation between qualities. We have data since 2005, and we have captured two main indices representing quality and value. One is called the Nifty Quality Index. The other is called the Nifty Value Index. Let me just interpret the blue line for you first. The blue line essentially is the difference in the quality index versus the value index on a 5-year rolling basis. Each point on the blue line signifies the outperformance or underperformance on a 5-year basis of quality versus value. For ease of interpretation, it should suffice to state that whenever the blue line hits the top of the chart, that's the period of maximum outperformance of quality versus value seen over a 20-year context. Whenever the blue line hits the bottom on the x-axis, that's basically the point of maximum underperformance of quality versus value, again, as seen over a 20-year data period. As you can see right now on the extreme right, we are going through a phase of quality underperformance. Now, what's important to see is that whenever we see this phase of quality underperforming value significantly, what does it hold for investors who continue to stay invested in quality over the next few years? And this is where the red line is important for us. The red line is basically the prospective 3-year return at any point of time. So let me just go back into history. Let me just draw your attention to August 2017, somewhere in the middle on the x-axis. That was the phase where quality was underperforming the x-axis, as you can see there. But for those who just kept holding on to quality and kept believing in the ability of businesses to continue generating strong outcomes regardless of how their stock prices are reacting, were actually rewarded for this patience, because over the next 3 years, quality actually outperformed value by a whopping 30% per annum. So we are at a similar stage right now. I must mention once again, this does not mean that quality starts to outperform from tomorrow. Who knows? It may well be the case, but always difficult to call out the exact turnarounds and the turning points. But this chart actually gives us a very, I would say, positive picture around holding on to your style, especially at the point of time of maximum pessimism, because that usually is rewarding in the long run. Yeah. By the way, when it comes to how quality has been doing against value, let me draw your attention to the two tables at the bottom first. Quality has actually started outperforming value globally as well as in the US. MSCI quality versus MSCI value, both for the global markets and USD3 year to date 2024, also we see the same trend. Obviously, what's helping is the view being formed around peak interest rates and the fact that interest rates should start to climb down sometime during the course of this year, and that's obviously helping high duration businesses. Quality benchmarks do have a fair share of high duration businesses. But in India, unfortunately, that's not been the case. Without going into the merits and reasons for why this has happened, but we wanted to show you this picture that in India, every year since 2021, quality has massively underperformed value. So is the case this year. That's something which, of course, has been hurting quality focused portfolios like ours. But the data on the previous slide makes us confident that at some stage, like everything mean reverts, this too will mean revert. And we are very smartly positioned in terms of our key holdings to actually capture the outperformance and actually generate alpha whenever this happens. Yeah. Next. As a consequence of whatever I spoke over the last 2 or 3 slides, the end result is that the P premium of our strategy versus MSCI India has significantly fallen below the mean. A high quality, high growth strategy like ours would always trade at a premium. We have been trading over the last 10 years at a premium of around 40%. And certain points of time, the valuation goes higher than 40%, just like, whenever quality is not in favor, the valuation premium drifts below the average. Over the last couple of years, as you can see, we have been significantly below the average. At today's point in time, this number is just over 20%. The average, like I mentioned, is 40%. So clearly, the markets may be overvalued, but our strategy related to the market is certainly undervalued today. And that's also giving us confidence. Yeah. Let me very quickly cover, 2 companies for you. I have this time picked up Dixon Technologies. This is India's largest company when it comes to electronic manufacturing services. We have been talking about reforms in India by Mr. Modi to actually make India the manufacturing hub in Asia. Of course, China is the big daddy, will remain the big daddy, but there have been efforts to actually improve the manufacturing percentage, of GDP in India. There have been multiple policies. The one policy which has really catapulted and kickstarted, the manufacturing efforts has been the production-linked incentive plan. And there have been a few companies which have been able to grab this opportunity with both hands, and Dixon on the listed space is certainly one of them. It actually has been partnering, big global giants across multiple industries, whether it be mobile phones, whether it be laptops, whether it be consumer durables like washing machines and so on. The gratifying thing is that despite capturing this growth and despite growing at a breakneck speed, which also means that despite putting capacities year after year to cater to this huge demand, the company has been very, very strong in terms of its return on capital. So what caught our attention was its very sharp focus on not letting return on capital go down, at the same time not missing out on huge growth, but creating a winning business model which is mindful of not letting the profitability drift, but at the same time also maintaining super strong growth. As you can see here, the company has been growing at 30% plus while improving margins and while maintaining return on capital in the vicinity of around 20%. Yeah. The next company that we have is one of the largest fashion retailer or apparel retailer in India. This is a company called Trent. It belongs to the Tata Group. And this company has been in existence for 20 years. I can say that the first 10 years, they struggled to get the model right. They tried lots of permutations and combinations, but I would say somewhere around 2015-16, they did discover the right model, which can help them not only stay relevant for their customers, but also help them in terms of being extremely profitable. As you all are aware, fashion retailing is not an easy business. Who have created a profit. Their journey has been a JV which they formed with Zara. And I think they picked up a lot of learnings that Zara had globally and also in Asia. But they moved on from there. The JV still continues, but they moved on from there. They've been coming out with multiple different formats and they've been meeting success. Again, the good thing here is that they have been continuously improving their margins They've been again growing at unbelievable growth numbers, but again without compromising on profitability. The next slide shows you their journey over the last 10 years, both in terms of how they have grown their number of stores across the country, and also how they've grown their own revenues and profits. Like I mentioned, profit growth significantly higher than revenue growth because of ever improving margins. The good news here is that in this particular industry, we have the natural tailwinds of unorganized to organized shift. India remains a predominantly unorganized market. And the organized players, by which I mean organized players in apparel retailing, all add up to just about 10%. As we all know, like has happened in many other emerging markets, eventually the unorganized guys keep losing market share, the organized guys keep gaining market share. So apart from the overall industry itself growing at 10%, the other tailwind for players like Trent has been the consolidation and ever improving market share. So we remain positive on this. We have captured some of the other unorganized to organized shift in certain other industries like jewelry, like food and grocery retailing through other companies. Trent has been a relatively new name for us, but has done well for us. The next slide is basically on our sectoral breakup. Not much change, I would say. We continue to remain extremely bullish on consumer goods and services. Like I mentioned, that's the bedrock of our strategy. We feel that India will continue to witness strong consumption growth on account of improving per capita income, aspirational middle class, young consumers who obviously have a proclivity towards consumption much more than middle-aged or old-age consumers. So I think all of these things have helped the consumption story in India over the last couple of decades, and I think the template will only continue to roll forward over the next couple of decades. We always have a very heavy focus on such kind of businesses. Apart from that, we remain positive on healthcare and IT. And of course, banking in India, which has been financing a lot of discretionary consumption expenditure. But here we are more focused on those institutions which have shown a very strong track record of underwriting over the last decade or beyond. Yeah. The next slide is basically our top 15 holdings. Our churn ratio, as you're all aware, continues to remain low, less than 10%. So there isn't much change on the left and between the left and the right hand side. The one change that is very visible to your eyes is LTIMindtree from number 1 position has come down to number 4. I mentioned earlier, this has been conscious. We realized that there has been a disappointment in terms of execution, and therefore we thought that it's not appropriate for us to let it be our number 1 position. Other than that, there would be mark-to-market changes, but nothing great to write home. Yeah. 3 new entrants, again, reiterating the fact that there aren't many entries and exit in any given year. Churn ratio is low. There weren't any exits in the last 12 months. There were 3 new companies, Dixon, Polycab, Metro. I've already spoken about Dixon. Polycab is a company which is India's largest cables and wires company. This is a company which actually has been benefiting on account of multiple things happening in India over the last few years. It has actually benefited from a recovery in real estate, being the largest wires company in India. And as we all know, when real estate construction starts, whether it's residential or commercial or retail construction, it always leads to very heavy demand for buyers. India has also been investing into the power sector. I did earlier talk about demand outstripping supply. And we have been investing a lot into solar and wind. That's leading to demand for cables. And that also is helping in Polycab. The last growth engine for Polycab, and it's been a significant one, has been again China Plus One. US has been putting restrictions in terms of imports of cables and wires from China. That's been benefiting, players outside of India. Polycab, which had its facilities ready about a couple of years back and had gotten those capacities actually approved by their clients based in the US, has actually seen huge amount of growth coming in from exports to the US market, and they've barely scratched the surface. They're a fraction of a fraction in terms of market share. So China Plus One opportunity is impacting multiple industries positively. It's ultimately up to the ability of the company to spot that opportunity, get capacities up and running, and then do some smart execution. Metro Brands is basically one of the largest footwear retailers in India. Again, very similar to Trent. The story here is also, of course, unorganized to organized, and also, our excitement is around the track record of this company in terms of being the most profitable, by a significant mile, the most profitable footwear brand. Yeah. Okay, this is the last slide before we open up for Q&A. The big picture here is that, are we mindless about valuations? Do we just let positions keep growing in our portfolio if, let's say, there is a big price run up? The answer we've always maintained is no. We don't sell out of these companies just because they've run up, but we are always conscious about valuations. We prune down, exposure in these companies when we see an unwarranted increase in valuations. At the same time, we never get unnerved if something is going through headwinds right now, but those headwinds, may last for only a few quarters without any significant damage to the business. And during times like these, we inevitably, end up increasing exposure. So our behavior usually is anti-cyclical. Within the realms of quality and growth, we are always contrarian and anti-cyclical. We never get too excited if there is, if there is, let's say, a few quarters of excitement around any business. We also don't get unnerved when there is, let's say, weakness in the upcoming quarters about a business which otherwise is very structurally strong. So at this note, I would just hand over back to Shivani to lead us into Q&A.
Thank you, Ajay. Thank you, Vetri. So if anybody has any questions, you can post it in the Q&A section. The first question is for you, Vetri. While India's macroeconomic position has improved over the past few years, are they sustainable? What is your outlook on the movement in Indian rupee?
Sure. So if you just step back and look at what has contributed to India's sort of stable macroeconomic platform, which is what I like to describe it as, it actually goes back to one of those first slides I had in the presentation today, which is to really talk about the emphasis on fiscal discipline, where we have seen the government sort of control the fiscal deficit, not let it get out of control. And in fact, post-COVID, you could argue that their emphasis on using whatever fiscal firepower they had on capital expenditure from the government account rather than into putting money into every Indian's pockets has again sort of helped drive the economy through the supply side rather than through the demand side. And that has sort of kept many of the macroeconomic stable, though you could argue that it's also created a little bit of an imbalanced recovery in terms of the K-shaped recovery that we often talk about. The second thing that I think Shivani has really contributed to India's macroeconomic stability, and this goes back to learning from our previous lesson. The lesson that we learned after the global financial crisis was that responding to the global financial crisis with very large fiscal stimulus, putting money into people's pockets, eventually created a problem for us in terms of runaway inflation, a fiscal deficit that was too large, and a trade deficit and current account deficit which was too large. And that's why India really suffered during 2013 on account of the taper tantrum. We were one of the worst affected economies. Today, the focus on fiscal discipline combined with the inflation targeting policy that has been in place for over 7 years now has actually meant that government policy along with the Monetary Policy Committee has been very focused on inflation control. And while inflation targeting is the mandate of the Monetary Policy Committee, what we've actually seen is that the government use fiscal measures to the best of its ability to also try and tackle some price-related issues in the economy when it has been able to do so. So I would say the second source of the better macroeconomic platform that you're seeing for India is really this focus on inflation and being aware of the fact that inflation can not only damage your macroeconomic stability, but I think politicians, much smarter than all of us, also recognize that it can cause them to lose elections. And I think there's sort of a triangulation there of the interests of the people, macroeconomic stability, and politicians and governments to say we want inflation to remain under control. The third element, which I would say is something which has been playing out more in the way that our economic growth in India plays out, is that today's services exports from India have become very, very significant. So if you look at the financial year 24, year ended March 2024, roughly the trade deficit, which is the deficit on account of trade in goods, would amount to somewhere about $240 billion, just, back of the envelope calculations. And if you compare that to the trade in services, India actually has a surplus of a little bit close to $100 billion in services. So therefore, when you take the combined deficit on account of both goods and services, you're down to only about 140 billion number. Now, in addition to that, one of India's biggest exports, which doesn't get counted as exports, is the large Indian workforce that goes overseas to work in other geographies. A large portion in terms of people are, of course, in the Middle East, but a large number of people are also working in the developed economies. And today, India receives close to $80 to $100 billion of inflows from these Indians working overseas. So you've got $140 billion of a deficit on goods and services, you're getting about $100 billion of remittances. Your gap is now down to $40 billion, and that's our current account deficit. Now, this number, mind you, if you go back to 2013, looked more like about 3.5–4% of GDP as opposed to 1.5% of GDP, and that created a lot of macroeconomic instability at that point of time. So these are the three reasons that I would point to, which is India's hard-won battle for macroeconomic stability, and I think that will continue to be the playbook of governments that come in the future. And to that extent, therefore, the view on the rupee as well has got to be a lot more constructive relative to what we've seen in the past. So, if US manages to get inflation down to 2%, India's inflation target being 4%, roughly you could budget for about 1.5% to 2% depreciation in the rupee, presuming we are not able to offset some of that with productivity gains. But I would submit that we are in a decade of 1.5% to 2% currency depreciation, if at all, and it could get offset by productivity rather than the 3–3.5% we've seen in the past.
Thank you, Vetri. The next question is also for you. The probability of the incumbent government getting re-elected appears to be high. What would be the likely consequences of a re-election, or in case there is a surprise outcome?
Well, I wish I knew, but nobody knows what the outcome will be. But having said that, the opinion polls do give you a good idea of which way the wind is blowing. And we've talked about this before. It's not very clear that there is any sort of a threat to the re-election of the current government. You never know how the public votes, but I would say the threat is very limited. If they come back, I would submit it's largely continuity in policy. Maybe some of their ongoing agenda items like the need to raise manufacturing share of GDP, create more manufacturing jobs, maybe some of that will continue to garner more attention. We know that the agriculture sector continues to have problems, very politically sensitive area, but I think that will be another area where the government will have to engage more in terms of nitty-gritty rather than, big reforms that, sort of dominate the headlines of newspapers. So I would say that's the area where I would look for continuity, manufacturing and agriculture. If there is an election surprise, well, let's make the assumption that it would be the opposition parties led by the Congress in some form and fashion. The first point I would make is that the story of India over the last 30 years since liberalization has always been one of consistent forward movement without any party, even when governments have changed, making a significant U-turn in terms of policy direction. GST is a policy item which has been carried by 4 different governments of very different political color, and it finally was implemented in 2017 under this current dispensation. But 4 different governments over a period of time had given it support. And I think that's the way to think about the way the Indian polity works. But I would say the Congress's track record in terms of fiscal discipline has been slightly wanting in the past. So if you're worried about one area in terms of how they would do, that could be fiscal discipline. But at the same time, inflation targeting again, implemented in 2016-17, but it was an item on debate for almost a decade before it got implemented. So many people within the previous government dispensation prior to 2014 were also part of that discussion. So I do think that will continue. So I would basically submit that don't expect any dramatic big U-turn in terms of policy. I don't see that happening. There could be some tweaking around policies because each party has its own pet policies, particularly in terms of more social sector policies and how they impact individuals. So there could be some tweaking around that. Some genuine concern about how a new dispensation different from the current one might think about fiscal discipline. But other than that, I would submit, don't expect anything dramatically different.
Thank you, Vetri. The next question is for you, Ajay. Could you share some example of companies in the portfolio that have underperformed in terms of share price but have continued to show good earnings, growth, quality?
I would say the example that comes top of my mind is Kotak Bank and Bajaj Finance. Both are showing strong earnings growth. I would say in case of Kotak Bank, over the last 10 years, the trend line in terms of net interest income growth as well as overall net income growth has been in the high teens between let's say 17 to 20%, and the number has been no different in the last 3 years. Share price obviously in the last 3 years is flat to, if I'm not wrong, a slight decline over a full 3-year period. So Kotak is one of them. Bajaj Finance, which is the largest NBFC in the country now, is also showing a very similar trend of strong earnings momentum. In case of Bajaj Finance, we've also seen improvement in ROAs from 4% to 4.5%, and yet stock prices have been flat over the last 3 years. So these are two top of mind examples from the banking sector. There have been similar examples from some of the other sectors like retailing. DMart is a case in point. It's a big holding in our fund, and that too has seen a big derating. Some of this derating obviously is on account of long duration. Interest rates moving up does have an impact on intrinsic value. Some of it has been, let's say, the general abhorrence towards quality. Yeah.
Ajay, the next question is again for you. What's your view on rural consumption? The question is linked to the strategy's bet on consumption goods. In other words, how do you encase the urban-rural dichotomy in your strategy?
So that's a very good question. And to be honest, some part of slowdown that we've been witnessing in consumption over the last few years has indeed been on account of rural economy being soft. And the softness in rural economy actually predates the pandemic, but the pandemic made it actually much worse. And that's why this whole new, recovery, which is now known as K-shaped, that this term was coined. And India too had its own share of a K-shaped recovery, where some part of the society really actually benefited out of wealth effect. Markets kept going up all through, and therefore that led to a general wealth effect in the economy for certain part of the social economic strata, and that led to strong consumption trends. But equally, the weaker part of the society actually not only did not enjoy, I would say, the wealth effect, but got, I would say, impacted by higher inflation that was running through 2021, well into 2022. So the only good news I can report right now is that over the last 2 quarters, and most definitely over the last 15-20 days, India is right now into the reporting season. Earnings for the quarter ended March are being reported as we speak. And I would say unequivocally, most companies have come back and said that rural is now doing well for us. I would say majority are saying that rural is now back in shape and doing slightly better than urban for us. This is also an year where we expect normal monsoons. Last year wasn't normal monsoon. So hopefully we should see rural coming back. I can make a more certain statement, hopefully by the next quarterly call that we have, but there are early signs that rural comes back. See, we don't change our portfolio a whole lot just because we expect that rural will do well or not do well. I mean, businesses for us find a place in the portfolio because of what we expect of them over the next 3 to 5 years. And over a 3 to 5 year period, you can obviously have very short cycles of sometimes urban doing well, sometimes rural doing well. I mean, we don't swing the bat just because we see something happening over the next few quarters. Yeah.
Thank you, Ajay. Again, the next question is for you. What is your view on the growth prospects of the infrastructure and real estate sectors? Given the most important companies within these sectors struggle to pass the quality test, is there any other way the fund might benefit from such a growth?
I think this is an excellent question, Shivani, and I think we do get this from a lot of our clients who feel that India is now seeing a cyclical bounce back in multiple sectors, infrastructure because of the push by the government, and real estate because the cycle is coming out of a 10-year kind of a slumber. And we kind of agree to both these statements. We do see real estate cycle remaining strong for the coming years. We also feel that government's push towards infrastructure may slightly reduce given fiscal deficit constraints that Vetri spoke about, but it's not going to be taking the foot off the pedal completely. How do we resolve this? Look, I must reiterate once again, we will never lose sight of our North Star, which is if businesses are not creating economic value, what's the point in making an investment in them, especially for investors like us who look at buying something and holding on to them for fairly long and enjoying wealth creation or alpha generation on account of the outcomes produced by the business rather than the price at which we catch them and the price at which we sell them, or our own smartness about catching the cycles right and selling out to a greater fool at the end of our holding period. So it is important for us to own businesses which are making sense. And the good news here is that while real estate companies per se, as defined in the JICS framework, may not in general qualify or pass our litmus test, but please be aware of the fact that there are a whole host of companies within our portfolio and have been there for the last many, many years, which are going to be positively impacted by this real estate cycle. In fact, I would say the growth rates of building material companies like Asian Paints, Berger, and Astral combined, which have a 6% weightage in the fund, are going to see tailwinds if real estate cycle continues to remain strong. They've actually seen softer earnings over the last 10 years because they do get influenced by the real estate cycle. There are other examples in our portfolio, like, for instance, cables and wires companies. I did talk about Polycab. We also have Havells in our portfolio, which is the second largest cables and wires player. Havells also is India's largest consumer durable players in certain segments. So we've seen consumer durables also sees a leg up as real estate cycle. So suffice to say, if I were to answer it in one single sentence, giving you a data point, there are more companies in our portfolio. There are multiple companies in our portfolio which get positively influenced by the real estate cycle. They all add up to more than 10% across different subsectors. But yes, that's how we wish to play the real estate cycle. Yeah.
Thank you, Ajay. In the interest of time, I think this is the last question that we'll be taking. This question is for you, Vetri. To international investor, the return on a currency adjusted basis is important. Could you comment on this?
Sorry, will you repeat that, Shivani?
To international investor, the return on a currency adjusted basis is important. Could you comment on this?
No, absolutely. I think, obviously currency adjusted returns is what every investor should be, focused on. And the good news is that, I think the stability in the Indian currency has contributed positively to investor returns in recent times, or at least not been a significant drag on returns in recent times. But I would submit that India's inflation target will always be higher than where the US inflation target is. And therefore, a 1 to 2% depreciation is something that I would expect, but it can get offset simply because the scope for higher returns exists, because the opportunity for growth is higher. And at the same time, I think particularly in our quality growth strategy, which is IDEF, the kind of companies that we are invested in have very high return on invested capital. And that itself, to my mind, is the key driver of returns of the strategy. Because if you think about it, eventually the returns that the stock market can deliver you somewhere over the long term have to align with the return on capital generated by the company. And therefore, that should be the bigger and dominant, contributor to returns, and should diminish the negative impact that any currency depreciation would have on it.
Thank you, Vetri. Thank you, Ajay. Thank you, everyone, for joining. Thank you, Shweta. Have a very good weekend ahead.
Thank you. Thanks, everyone.
Thank you, everybody, for joining us. Thank you. Have a great day.